A practical guide to building wealth through intelligent investing. Imagine two people earning the same income. One works for 40 years and struggles financially despite earning decent money. The other builds a portfolio of investments that continues growing while they sleep, eventually creating financial freedom. What separates them? It's not luck. It's not a higher salary. It's not secret investment opportunities. The difference is understanding how money works and making smart investment decisions consistently over time. In today's video, we'll break down the key principles from the Smart Investor Handbook and explore how ordinary people can build wealth through intelligent investing. By the end of this video, you'll understand why investing matters, how successful investors think, and the practical steps you can take to begin building long-term wealth. Let's begin. Chapter 1: The biggest investing myth. Many people believe investing is only for the rich. This belief has kept millions trapped in a cycle of working hard but never allowing their money to work for them. The truth is that investing is not about how much money you start with. It's about developing the habit of consistently putting money into assets that grow over time. Consider this. If someone invests a small amount every month and earns reasonable returns over many years, the power of compounding begins to take effect. Compounding occurs when your money earns returns, and those returns begin earning returns as well. Albert Einstein reportedly called compound interest the eighth wonder of the world. Whether or not he actually said it, the principle remains true. Small amounts invested consistently can eventually become significant wealth. The smartest investors understand that time is often more important than the amount invested. The earlier you begin, the greater your advantage. The best time to start investing was years ago. The second best time is today. Chapter 2: Think like an owner, not a gambler. One of the biggest mistakes new investors make is treating investing like gambling. They chase hot stocks. They follow rumors. They buy assets simply because everyone else is talking about them. Smart investors think differently. They view investments as ownership. When you buy shares in a company, you're not purchasing a lottery ticket. You're buying a small piece of a real business. Ask yourself, would you invest in a company if nobody else was talking about it? Would you invest if the market closed tomorrow and remained closed for 5 years? Smart investors focus on fundamentals. They examine revenue growth, profitability, competitive advantages, management quality, long-term potential. Instead of asking, how much money can I make this week? They ask, will this investment create value over the next decade? That mindset alone separates investors from speculator. Chapter 3: The power of patience. We live in a world obsessed with quick results. Everyone wants instant success, instant profits, instant wealth. But investing rewards patience. The stock market has historically experienced ups and downs. There are periods of growth. There are periods of fear. There are periods of uncertainty. Many inexperienced investors panic during market declines. They sell when prices fall. Then they buy again when prices rise. In other words, they buy high and sell low. Smart investors do the opposite. They understand that temporary declines are often normal. Market volatility is not the enemy. Emotional decision-making is the enemy. Patience allows investors to benefit from long-term growth rather than being distracted by short-term noise. Remember this. The market transfers money from the impatient to the patient. Chapter 4: Risk is not what most people think. When many people hear the word risk, they think of losing money. But smart investors define risk differently. Real risk is not temporary price fluctuations. Real risk includes not understanding what you're investing in, putting all your money into one asset, making emotional decisions, ignoring financial education, One of the most powerful ways to reduce risk is diversification. Diversification means spreading investments across different assets. Instead of relying on one company, one stock, or one investment, you spread your exposure. Why? Because nobody can predict the future perfectly. Even great companies can face unexpected challenges. Diversification protects you from catastrophic mistakes. The goal isn't to eliminate risk. The goal is to manage risk intelligently. Chapter 5: The Investor's Greatest Enemy. Surprisingly, the biggest threat to your investment success isn't the economy. It's not inflation. It's not market crashes. It's often yourself. Human emotions can destroy years of progress. Fear causes investors to sell too soon. Greed causes investors to take unnecessary risks. Excitement leads to impulsive decisions. Successful investing requires emotional discipline. Before making any investment decision, ask: am I acting based on facts or emotions? Am I following a plan or reacting to headlines? Am I investing for the future or chasing immediate gratification? The most successful investors develop systems that prevent emotional decision-making. They create rules. They follow strategies. And they remain disciplined regardless of market conditions. Chapter 6: The Importance of Continuous Learning. The financial world constantly evolves. New industries emerge. Technology changes. Markets adapt. Smart investors never stop learning. They read books. They study businesses. They analyze market trends. They learn from mistakes. Financial education is one of the highest return investments you can make. Unlike money, knowledge cannot be taken away once acquired. Every successful investor started as a beginner. Nobody is born understanding markets. The difference is that successful investors commit to learning consistently. Even one new financial lesson each week can transform your decision-making over time. Knowledge compounds just like money. Chapter 7: Building a Personal Investment Plan. Many people fail because they invest without a plan. A smart investor begins by defining clear goals. Ask yourself: why am I investing? Do I want retirement security? Financial freedom? A future home? Education funding? Once your goal is clear, create a strategy that matches it. A strong investment plan typically includes: Step 1. Build an emergency fund. Before investing aggressively, ensure you have savings available for emergencies. Unexpected expenses happen. An emergency fund prevents you from selling investments at the wrong time. Step 2. Invest consistently. Consistency often beats perfection. Investing regularly removes the pressure of trying to time the market perfectly. Step 3. Focus on long-term growth. Avoid being distracted by daily market movements. Focus on years rather than days. Step 4. Review and adjust. Monitor your progress periodically. As your financial situation changes, your investment strategy may need adjustments. Chapter 8: The Secret of Wealth Creation. Many people search for secret investment strategies. They look for hidden formulas. They chase shortcuts. But the truth is surprisingly simple. Most wealth is built through a combination of discipline, consistency, patience, financial education, long-term thinking. The wealthiest investors often follow basic principles exceptionally well. They save consistently. They invest regularly. They avoid emotional decisions. They stay committed during difficult periods. They allow time and compounding to work in their favor. The secret is not complexity. The secret is consistency. Conclusion. The lessons from the Smart Investor Handbook remind us that investing is not about getting rich overnight. It's about making intelligent decisions repeatedly over time. Remember the key principles. Start investing as early as possible. Think like an owner, not a gambler. Practice patience. Manage risk wisely. Control your emotions. Continue learning. Follow a clear investment plan. Stay consistent. Financial freedom rarely comes from one lucky opportunity. It comes from thousands of smart decisions made over many years. The question isn't whether investing works. The question is whether you're willing to give it the time, discipline, and consistency it requires. Your future wealth is being shaped by the financial decisions you make today. Make them wisely. If you found this lesson valuable, subscribe to Money Made Easy TV for more wealth-building insights, financial education, and practical strategies to help you make money work for you. Until next time, keep learning, keep investing, and keep building your future.